Most investors don't fail because they picked the wrong stock. They fail because they picked a volatile stock, panicked when it dropped 20%, and sold at the bottom. Volatility is the enemy of compounding. Today, we are shifting gears. We are looking for the holy grail of investing, stable growth. We want the upside of the market, but with the safety of a fortress. Your portfolio isn't a game anymore. It's your peace of mind. If you remember 2022, or worse, 2008, you know the fear. When the market turns sour, the standard S&P 500 VOO funds you own can drag you down. In the last major correction, the stock market dropped about 18%. That loss takes years to earn back. But this is the secret your broker won't tell you. You never had to take that full 18% hit. What if you had owned two secret strategy funds? While the standard S&P 500 was down nearly 20%, these two champions were only down 7% and 10%. Today, we are putting your standard S&P 500 VOO fund against these two massive wealth protectors. So let's cut to it. It's the simple power of VOO against the deep value of FNDX and the financial perfection of SPHQ, the quality ETF. These three represent the three rules of the market. VOO, the popularity contest. It buys more of whatever is most expensive. It's a momentum machine built on price. It's powerful but volatile. FNDX, the contrarian. It ignores the price tag and focuses on the economic footprint, sales, cash flow, and dividends. It buys what's cheap and unloved. FNDX is your crash helmet. SPHQ, the elite filter. It screens for financially bulletproof companies based on low debt, high return on equity, and stable earnings. SPHQ is your high-performance engine. FNDX gives you stability by being cheap. SPHQ gives you stability by being elite. Both are miles ahead of VOO when it comes to riding out a storm. Before we run the math, let's talk about what's actually inside these funds, because their holdings are the entire story of stability versus volatility. First, VOO, the popularity contest. VOO is simple. It owns the 500 largest companies weighted by price. You own the giants like Nvidia, Apple, and Microsoft. In fact, these three companies alone make up roughly 21% of the entire fund. VOO is highly concentrated in big tech and is therefore heavily exposed to the momentum and price swings of the technology sector. Second, FNDX, the value rule. This is where it gets interesting. FNDX uses its value filter, which often forces it to sell high-flying tech. While it still holds some Apple and Microsoft, their weightings are much lower. FNDX is deliberately overweight in sectors like energy, like ExxonMobil and Chevron, and financials, like JP Chase and Berkshire Hathaway. These are companies with massive cash flow and high dividend yields, the kind of boring, stable businesses that thrive when the market is struggling. SPHQ, the quality rule. SPHQ is the smartest shopper. It picks only the best companies based on low debt, so you get a balanced mix of financially bulletproof companies. Its top holdings include stable, high ROE giants like Apple and MasterCard, along with defensive leaders like Procter & Gamble and Costco. SPHQ cuts out the weakest 80% of the S&P 500 to leave you with a portfolio of only the financially elite. This composition is why their performance diverges so sharply. Now let's see those numbers. Okay, pause the money talk for 1 second. I'm giving you the blueprint to financial freedom here. The only thing I ask, smash that like button. It tells the YouTube algorithm that you guys like making money. And if you haven't subscribed yet, what are you doing? Join the tribe. We are building wealth together. Okay, back to the charts. Let's see how they actually performed in a recent downturn, because that's what defines stability. VOO, down about 18 to 20%. FNDX, down only about 7 to 9%. FNDX was the clear defensive champion, achieving that massive buffer by tilting away from crashing tech. SPHQ, down around 10 to 12%. It was the stable middle ground, better than the market, but still holding high-quality growth stocks. We also look at value. FNDX is the cheapest at a PE of 18.6x, giving you the biggest margin of safety. VOO is the most expensive at 28.5x. Let's make this practical. Forget percentages. Let's look at cold, hard dollars. We are taking $5,000 and investing it in each fund, compounded over the last 10 years. First, the annualized returns. VOO averaged 14.56%, SPHQ averaged 13.90%, and FNDX averaged 12.59%. Now, let's see where that money landed after 10 years. Starting with $5,000, the VOO portfolio finished with a staggering $19,521. SPHQ finished with $18,485, and FNDX finished with $16,309. The math is undeniable. VOO generated over $3,200 more than FNDX. This dollar test reveals the ultimate trade-off. Stability, FNDX, comes at the cost of maximizing historical growth. If you never panicked, VOO rewarded you handsomely. If you needed that safety net, FNDX protected your downside. That underperformance from FNDX wasn't just due to strategy, it was heavily impacted by the cost. You pay a premium for that smart filter. Let's look at the expense ratio, the annual fee you pay. VOO is essentially free at 0.03%. That is the undisputed king of efficiency. FNDX costs 0.25%. That is nearly 9 times more expensive than VOO. SPHQ sits in the middle at 0.15%. FNDX's higher fee acts as a heavy anchor, dragging on its long-term compounding. When you look at the math, you have to ask, is the added safety worth the premium? This is the bottom line. It all comes down to your age and your biggest fear. If you are under 50 and accumulating wealth, stick with VOO. The lower fees and the exposure to high-growth tech are mathematically likely to beat the smart strategies over 20+ years. If you are near retirement, fear a major crash, or cannot stand volatility, FNDX is your winner. The 0.25% fee is your low-volatility insurance policy against a major loss. If you want a stable growth fund that focuses on financial excellence, SPHQ is your winner. It's the perfect compromise that gives you better quality companies than VOO without the deep value drag of FNDX. Remember, the best fund is the one you can hold on to when the market drops. Whether you choose the efficiency of VOO, the safety of FNDX, or the excellence of SPHQ, you are making a smart, informed choice. Which smart money camp are you in? VOO, FNDX, or SPHQ? Let me know in the comments below. Smash that like button if this math helped you decide, and I'll see you in the next video. Keep compounding.